While everyone is talking about Jeff Epstein and the files and the people who are involved with the atrocities, something else was happening behind the scenes. Over 12 trillion was crashed from global market in just 48 hours. Why? This was not a normal volatility. This was a structural unwind across metals and equities happening at the same time. Let us look at the damage. Precious metals collapsed. Gold fell by 16.36%, wiping out $6.38 trillion. Silver fell by 38.9, wiping out 2.6 trillion. Palladium fell by 29.5 percentage, wiping out 2.5 billion US dollars. Palladium fell by 25%, wiping out 110 billion. If you look at the equities, SP 500 fell by over 1%, wiping out 1.3 trillion. Nasdaq fell by over 3%, wiping out $1.3 trillion. Russell fell by over 2,000, wiping out over 100 billion US dollars. In total, over 12 trillion vanished, which is more than the GDP of Germany combined, India and Japan. When you combine those GDPs of those three countries, the 12 trillion is more than what was wiped out of the stock market. Or metals were at historic highs. Silver had just printed 9 consecutive green monthly candles. That has never happened before. The previous record was 8 green month, and that marked a major cycle tops. Silver and already delivered over 3x return in 12 months. For 5 trillion to 6 trillion asset, that is extreme. At the peak, silver was up 65 to 70%. Gold was also deeply stretched after a parabolic run driven by easing expectations at those levels. Profit taking was inevitable. Momentum pulled in late retail and leverage. The vertical rally sucked in large wave of late bars rotating out of crypto and equities. Most of this money did not go into physical metals. That is a problem. It went into leveraged futures and paper contracts. Oh my God. The dominant narrative was simple. Silver to 150, to 200. That was most people betting. That encouraged oversized long positions right at the top. When the price rolled over, liquidation started immediately. Long liquidation cascade took over. And silver dropped, margin calls triggered, longs were forced out, price dropped more liquidation followed. That's why silver collapsed over that 5% in just one day, and it was not sellers choosing to exit, it was a forced selling. It started with JP Morgan, who forced the sellers. This is where now the problems comes, because the paper market stress and the physical reality. The silver market is heavily paper, driving estimated paper to physical ratio 300 to 350. That means hundreds of paper claims exist for every real ounce. During the crash, COMEX silver fell sharply. Physical market stayed elevated. At one point, US silver was trading at $85 to $90, and Shanghai silver was trading at 136. You see the difference? That gap exposed stress between paper pricing and the real demand. paper market and wind fast, physical market move slower. I would encourage everyone to, if you want to invest in these, invest in physical methods. Don't buy this paper market. And this was not a demand collapse. This was historic extension, extreme leverage, crowded position, forced liquidation, margin hikes, and a sudden policy narrative shift. If you look at all these things, they were forced and they happened overnight. If you look at everything right now, so I think the release of Epstein files was just a smoke screen for them to do these things. The the big banks and the big firms are now trying to salvage or protect themselves, while the masses are talking about the Epstein files. Because in the Western world, that is in USA, uh, things are crashing, and they are crashing heavily. The dollar, the banks, the stocks, everything.